Namaste. I am Dr. Partha Majumdar. I have been investing in the Indian stock market since 1994, and I've also invested in stock markets outside India. Now, since around 2004, I started seriously analyzing the stock market, and when I started my company in 2014, there was a period when I was seriously into stock market predictions, uh, doing technical analysis. For around 3 years, I consistently made a profit of about 35% from the stock market. Ever since that, I invest in stock market purely from an academic point of view. Now, in this video, I will walk you through a model I prepared for predicting the stock market using machine learning. I'll make the presentation brief and only touch upon the important aspects of this research. Ever since stock markets were devised, there has been efforts to predict the stock market. These efforts intensified when the modern stock markets were invented round about the early 1900s. However, till date, there has been no single stock market prediction model which can be absolutely relied upon. There has been efforts which have been yielding good results, but they are not absolutely foolproof. This research will take forward this process of making better models for stock market a few steps. Let's understand a few concepts which have been utilized in this research before we get into the details. Now, the stock market data is essentially a time series. What it means is that we observe different data points at different points of time, like time t minus 1, etc., and this forms a time series. Now, any time series has got four components. One is trend, another is seasonality, then there comes cyclicity, and then comes white noise. So if we try to plot a stock market data or a time series data, it looks something like this. Now, stock market data prediction has been proving very, very difficult, basically because people say that it is a random walk, and this has been proved. Now, essentially it means that the stock market data is a time series which is non-stationary. What we mean by non-stationary is that if we take the mean of the stock market data over time, it will vary according to the time. So, and another very important characteristic is that the variance of these data is not bounded. This is unbounded variance. Because of these characteristics, it makes it very difficult to predict non-stationary time series data. It has been proved that non-stationary time series data can be made stationary. So one such technique is called differencing. What we mean by differencing is that supposing we take 2 points of our time series data, that's let's say yt and yt minus 1, and we find the difference between yt and yt minus 1, and we carry on this process, then we will form a new time series. So this new time series, if I take a simple time series which is linear of the form beta 0 plus beta 1 into t, then you notice that if I do yt minus 1, I get beta 1. Now what it essentially means is that this new time series which I have formed from this simple linear time series is something which is not dependent on time. So this has become stationary. Of course, stock market data is going to be much more complex, but essentially what I mean by stationary time series data is that if I take this time series, I will have obtained a time series something like this. Now this time series has got a few characteristics. First characteristic is that this time series will have a constant mean. And second characteristic is that it will be having a variance which is bounded between two finite quantities. Lastly, if we take any two parts of the time series, let's say this part and this part of the time series, there is a correlation which exists between these two parts. Because of this correlation, if we take any data from this part of the time series, we can utilize that to predict the data for other part of the time series. So we will use this concept in this research and see how it can make time series predictions better. A reasonable amount of literature on various topics was studied for this research. Now, one of the important things about stock market theories, which was stated in 1970 by Pharma, was that the stock market data follows the efficient market hypothesis, which means that the stock market prices they include all the information which is available in the market. However, it was proved later that this is not quite true, and there are severe inefficiencies which exist in the stock market data. Because of these inefficiencies, the prediction models can be created on the stock market. According to Pharma's model, EMH, it was impossible to predict the stock market because of the efficient market hypothesis. Many models have been prepared to predict the stock market data. Which has been successful to some extent. For example, on the Nigerian Stock Exchange, there was a research done to predict stock market data using type 2 fuzzy logic. It provided around 60% accuracy in terms of predicting the stock market. Similarly, there has been efforts to predict the stock market data using deep learning. Also, there have been efforts by other people where they have utilized data like the Twitter data in the 1990s to capture the sentiment for a particular stock from Twitter data and predict the future prices of the particular stock. Another area of literature study was for the machine learning models and time series analysis. Now, in terms of time series analysis study, it was found that if non-stationary data can be made stationary, then it is possible to make reliable prediction models based on that. And a number of study was also conducted in terms of different machine learning models which is available for making reliable models. From the literature review, the following gaps were identified. Firstly, the existing research for stock market predictions is modeled on top of raw stock market data. Second gap identified was that there is very limited research available comparing the performance of different deep learning models, especially when these models are trained on stationarized financial data. Third gap was that the existing stock market prediction models did not incorporate macroeconomic indicators. Lastly, all the stock market prediction models available, they are proprietary and available to large organizations. There is no model which is open source and reproducible, which can be utilized by any kind of investor, whether he's a big investor or a small investor. Based on the identified gaps, this research tries to answer three questions. The first question is whether transforming the stock market data to stationary format influences the accuracy of machine learning models for stock market prediction. Second is whether our latest technology in terms of deep learning, that is Gated Recurrent Units, GRU, performs better as compared to other deep learning models like artificial neural networks, recurrent neural networks, and long short-term memory networks. Lastly, this research identified very early that it is not going to be possible to make a completely foolproof stock market prediction model, but it will take forward the research on stock market predictions. So it was stated that the limitations and challenges which exist after this research in terms of using machine learning for stock market predictions will be identified and mechanisms will be devised to alleviate such challenges. Based on what we have discussed so far, let us state the aim and objectives of this research. The most important question that this research tries to answer is whether making the stock market data stationary improves the predictive performance of the machine learning models. This is the main hypothesis which this research is trying to prove. Now, towards this, the following are the objectives. It will test whether the effectiveness of stationarity transformation on different stock market prediction models. Second, a comparison will be made between GRU models versus ANN, RNN, and LSTM architectures for stock market predictions. Third, the performance of different deep learning models on different types of stock market data will be measured using robust metrics and consistent metrics so that we get a sense of which kind of model on which kind of data performs the best. Fourth objective is that the research is trying to create a scalable and reproducible framework using open source tool and publicly available data so that the model is not only proved, it is also useful for all kinds of investors. So this will democratize the application of stock market predictions across all kinds of investors, whether they are small investors or large investors. Lastly, from these experiments, it will be seen what kind of limitations and challenges remain in stock market forecasting using machine learning, which can be alleviated in the future research. Let me walk you through the research methodology. A quantitative research design was chosen for this research. Now, the secondary data was collected from Yahoo Finance and World Bank. The data collected was as follows. Macroeconomic data was collected from World Bank. So the prices of gold, silver, crude oil, etc. These prices were taken. Along with these prices, the GDP value of the country and the currency exchange rate, these were all captured from World Bank data. And then from Yahoo Finance, the data regarding National Stock Exchange was collected. So now all of these data was captured for the same dates across a period of time. So this time series was completely captured. This is time. Now this data which is captured at this stage, this is the first data set, which is the raw stock market data. This data is completely raw. We will call this number 1. Now all of these data, all of these time series, whether it's gold price, silver price, oil price, or GDP, all of these are non-stationary data. Of course, we know that the stock market data is of course non-stationary. Now all of these data was stationarized using differencing, and after differencing, it was checked, each time series separately was checked whether they become stationary or not. Now this check was conducted using augmented deep Fuller test or ADF test, and by using KPSS test. Now 2 tests were employed so that we were certain that the differencing was definitely producing stationarized data. Only when both the tests said that the data has become stationary, only then that was considered as stationary data. Anyway, from doing this differencing on all the different time series, a second data set was obtained, which is the stationary stock market data. So this is the second data set. Now taking these 2 data sets, different models were created. Now using different network architectures, ANN, RNN, LSTM, and GRU, models were created separately for raw data and for stationarized data. Now to create the models also, what was done was that the entire stock market data available was so and so. Now from this, 5 years of continuous data was taken. On this data, a model was trained, and after training the model, the next 1 month data was utilized for testing the model. Now then once that was done, the window was shifted by 6 months, and next again 5 years of data was taken, model was built on top of this, and next 1 month data was utilized for testing. And like this, the process carried on by moving the window forward by 6 more months. So there were a lot of models which was created as part of this experiment, and this technique of using sliding window provided the opportunity that the models were created on different kinds of economic and political situations which prevailed during the different periods of time. So each model was capturing a different kind of a environment on which the stock market was existing. So these gave a lot of inputs into how stock markets reacts under different circumstances. Now, since we were predicting the stock market index, which is a continuous variable, it was not possible to create or capture metrics like accuracy. Instead, what was possible to capture was metrics like what is the mean square error and what is the R square score. Now, a low variance in R square proves that the models are generalizing better. Generalizing better means it can be utilized for future predictions. And a lower mean square error score basically means that the model's performance is much better. If the error is smaller, the model is predicting more accurately. So these metrics were captured for all the different models which were prepared. After these metrics were captured, then the final step was to validate the hypothesis. There were 2 hypotheses which was tried tried to be answered through this research. That is, whether the models built on stationary data perform better, and then we were trying to prove whether the GRU is better than LSTM, RNN, and ANN. Before proceeding forward, let us briefly discuss the different neural network architectures that was tested in this research. The first neural network architecture which was tested was the artificial neural networks, or ANNs. Now these are very simple form of neural networks, the basic form of neural networks. Now in these neural networks, we have an input layer where the input is provided, and then there are hidden layers. The hidden layers can be many, and it depends on the design which is done by the engineers. And in these hidden layers, we have the different neurons. These neurons basically take an input and then they process it and they produce output. Now, these neurons basically learn by updating the weights and biases. Now, the weights and biases are learned through forward propagation and backward propagation. And using the forward propagation, it tries to make a prediction of the output, and once the outputs are made at the output layer, it is compared with the actual values, and then it tries to update the weights by doing the back propagation, and then it tries to again does a forward propagation to say whether it's better and things like that. So this process carries on, this process of learning carries on till the neural network learns sufficiently. This is the very basic form of neural networks which is there. Now this model was basically utilized as a baseline, though we knew that this model cannot yield a very good prediction model for stock market. Now the next model which was tried was a recurrent neural network. In recurrent neural network, what was done was that this neuron of the artificial neural network was replaced by the recurrent neuron. The recurrent neuron is the same as artificial neuron, but it takes an input just like artificial neuron and produces the output just like artificial neuron. However, the output produced is again fed back into the neuron. So this recurrent neuron has got two inputs. One is the one coming from outside, and one is the output it is producing. Now, because of this architecture, these neurons, they have a memory. However, what happens is that when the sequence is being fed into the recurrent neuron, it takes the sequence, it has complete knowledge about the particular sequence. As the sequence progresses down, notice that the earlier sequence which was provided to this recurrent neuron, that loses its importance and that is lost in memory. So these recurrent neural networks are prone to losing memory. So the losing memory essentially means that the initial part of the sequences which is fed to the recurrent neural networks, they are lost and they have less influence on the predictive power of the recurrent neural networks. Now, because of this problem, a different kind of neural network was devised where this recurrent neuron was replaced by LSTM. Now, the LSTM architecture looks something like this, which is pretty complex, but however, this architecture has got some gates, and these gates are devised so that these LSTM neurons, they can retain the essential part of the memory and discard what is not required. Now, this architecture allowed the neural network, which was made on the recurrent or on the LSTM neurons, to understand sequences much better and retain the sequence and not have a memory loss just like the RNN used to have. However, this architecture, as you can see visually, is quite complex, because of which it was simplified in the gated recurrent unit neuron, where this simplified architecture does the same thing as the LSTM neuron, where it retains essential memory and discards unnecessary memory and has good power to not forget sequences and keep memory, keep intact the validity of the long-term sequences and still produce similar results just like the LSTM with a much simpler architecture. Having discussed how the research was set up, now let us start discussing the results. We will discuss some of the results only, which is the most essential to understand the conclusions of this particular research. The first result what we will see is that we will compare the R-square scores across different models. So first model we have taken up is the ANN model, and this model was trained on raw data. Now the R-square scores, how it is reflected in this chart is Now this R-square scores refers to the model which was trained over a 5 years period, so from this point to this point, and then the predictions were made over 1 month period. Now the R-square scores were captured for these predictions on the test data which was made on this 1 month period. So this experiment's data is reflected in this R-square score. Similarly, the window was moved forward with 6 months, and this is like this, and so on. So now from this chart, which is the ANN model trained on raw data, you notice that the R-square scores are very widely ranged. So the range of the R-square score is very wide. And even if I ignore this particular value, the R-square scores are in a very wide range, even if I consider just this much of value, because it is quite a large range between about 0 to minus 35. Now, the R-square scores, the property is that if it is higher, it is better. But the variance in the R-square score, if it is less, it proves that the model is generalizing better. So we can definitely say from this particular chart that this model is not generalizing quite well, because the variation of the R-square score is quite large. In comparison, when we take the same ANN model trained on stationary data, we notice that the range of the R-square score has reduced drastically. This is a drastic reduction in the range of the R-square scores. So this definitely proves that having made the data stationary, the model is able to generalize much better. However, the model has still got a variation in the R-square scores. Now there are some variations which are very prominent and some are pretty alright. So one of the variations is prominent is this point. Now here, if we take the general environmental data from the general environmental data, we notice that this is around the period when there was a recession in the world. So we can, though we will see this later on again, but in general we can say that when there is a external variation in the market, then it may become difficult for models of deep learning to capture those variations very accurately. Let us see this in more details in the later charts. This is the R-square scores of RNN models trained on raw data. Now you notice here that the variation in the R-square score has become even more bigger, even more prominent, and so this is also a model which will not generalize very well. And here you notice that these 2 points are very prominent, where the R-square scores have got a spike downwards. Now this is the period which is referring to the time when there was a global recession, and this is around the time when there was Indian elections. So definitely we can now say that these deep learning models, they may be able to predict the stock market. However, they cannot predict the stock market accurately during the times when there is a disturbance in the environment or there is an external shock in the stock market. Nevertheless, coming back to the core part of this model's analysis, we notice that here the R-square scores are varying quite largely, as a result of which we can conclude that this model is not generalizing quite well. So next, let us look at the RNN model trained on stationary data. Now here you first of all notice is that from about minus 350, this is reduced to around about minus 10. So the variance of the R-square score has come down very drastically. So this model is definitely much more better. So we are gradually able to see that making the data stationary has a very heavy impact on the predictive power of the deep learning models. Again, you notice here that these models, in spite of having a better predictive power and better generalizability, it is not able to model the external shocks. So it is around the same period of time when this model is also not able to make very good predictions. But here the variation has come down quite a lot, and here we can definitely say that this model generalizes much better as compared to the other previous models that we have seen so far. Let's proceed forward and see the LSTM model. The LSTM model, you notice here that here the variation, because the LSTM model understands the long-term sequences, so when there is a external shock, it captures the shock very effectively in terms of not being able to generalize at all. So otherwise it is doing pretty well, but however when there is a external shock, this is not able to capture that moment absolutely. And as a result, it provides a very bad R-square score around that point of time. Otherwise, this model also, because this is a very high score, this range looks to be small, but this is pretty large range. So there is a lot of variation in the R-square scores in the LSTM model trained on raw data. When we see the same LSTM model trained on stationary data, we see that the variance in the model has come down drastically. In spite of the variance having come down drastically, it is not still able to model the external shocks which is coming from the market. But this model is definitely much better as compared to the model trained on raw data. This is the model trained on stationary data. Lastly, let us see the R-square scores that is obtained when training the GRU model. First, we trained it on the raw data. Here we see that just like LSTM, in general, it is able to capture the R-squares in a defined range. But when there is external shock, it gives a spike. Here also, it looks like it is a very small variance, but this is not, basically because this range itself is quite a large range. So this model also is not able to generalize quite well. We will see that in the stationary data, when the GRU model is trained, this comes down drastically, and this model is generalizing quite well, except for the fact that it cannot account for external shocks, which we notice in these spikes. Otherwise, the model is generalized pretty well. Having gone through the comparison of the R-square scores, now let us compare the predictions made by the different models. To make the predictions on the models, what was done was that the last part of the data, which is the end of 2024, that part of the data was taken, and 3 months data was taken as marker, and 1 month prediction was made using the 5 years training data, which was utilized for modeling the model. So now the 1 month prediction is shown here. Now this orange line shows the prediction which is made. Now first model which we are seeing is the ANN model trained on raw data. We notice that this prediction is capturing the direction of the stock market pretty well. So now this is slightly misleading, basically because when we studied the R-square scores, we saw that ANN model was not generalizing very well, especially on the raw data. So this capture of the stock market movement, which is directionally quite accurate, is a misnomer, simply because this is something which is very difficult for this model to replicate in subsequent predictions. So we should not get carried away too much. Anyway, we trained the ANN model just as a baseline. So as a baseline, we can definitely understand that it's possible to make pretty accurate predictions of the stock market if we have the correct model with us. Next, let us look at the predictions made by the stock ANN model on the stationary data. On the stationary data, we notice that in the initial part of the prediction, when the predictions are made immediately after the model's training was completed, that is, the model's training was completed with data up to this range, we see that the prediction is pretty accurate. It is not only in value, also in terms of direction. However, as the time progresses, the predictions become very obtuse. So this is definitely not a very good prediction, but nevertheless, in the initial stage, it is able to capture the market's value quite well. So we can say that there is an improvement in the predictions made on the stationary data as compared to the raw data. Nevertheless, like I told you before, ANN model was just used as a baseline. It was never intention to utilize this for predicting the stock market. Let us look at the models which have got some memory. So first we look at RNN model. The RNN model on the raw data is predicting much better in terms of it is not a very good prediction, but nevertheless it is capturing some directions, but it has got an offset which is pretty large, and the offset keeps growing, and it is not capturing the directions, especially in these regions and all the kind of stuff. So this is also not a very good prediction which has been made by the RNN model when it was trained on the raw data. Now when you look at the predictions made on the models which have got a memory, you notice that the period of prediction is slightly different from the ANN model, simply because these models have a loop back period. So this here in this case, a 15-day loop back period was utilized. So that is why you see that the prediction date range is slightly different. Now let's look at the predictions made by the RNN model on the using the stationary data. So in the stationary data, you notice that in the initial part, the predictions are pretty good, but as the time progresses, the predictions becomes bad. So this model also, this is definitely much better as compared to the models trained on the raw data. So at least for a period of time, the predictions can be relied upon. We progress further to the LSTM model. First, we look at the LSTM model trained on raw data and its predictions. So here you see that the predictions are not at all good. It has not only got a downward offset, also it is not able to capture the directions of the market pretty well. So when we do the same thing on stationary data, again we notice that it is able to capture the market's value and direction for some time in the immediate future, but as the time goes on, the predictions become not reliable. Lastly, we look at the GRU model. The GRU model, remember that the R-square code suggested that these models are generalizing pretty well. So when we look at this prediction, we are very excited simply because this model, though it is trained on the raw data, it is capturing the market's direction pretty accurately. Though there is a offset throughout the predictions, but this is capturing the market's direction pretty accurately. Now, when we look at the same GRU model trained on the stationary, lastly, we look at the predictions made with the GRU model using stationary data. Now, this is very exciting simply because this predictions is not only capturing the values pretty accurately, it is also capturing the directions of the stock market very accurately. Also, we know that from the R-square score study that these models have generalized quite well. So we can depend on these predictions for future predictions as well. So you can see that the directions are accurately predicted and its starting point, even the value is pretty accurate. Now the investors, they are not very interested in the actual value of the stock market at a future point of time. What they are interested is in which direction the stock market will move. So from that perspective, this GRU model is providing a very good prediction which can be relied upon for stock market predictions. So we can definitely say that the GRU model is better compared to the other models, and especially the GRU model is better when trained on stationary data. So throughout this R-square study and the predictions, we can see that making the data stationary has made a difference. Let us look at this from a comparative chart and see how all the models stack up. So notice here that when we study the R-square scores, the minimum R-square scores and the maximum R-square scores are the best when the data has been stationarized. If we take the median, we have taken the median simply because there were a lot of outliers in the R-square scores that was captured. So if we take the mean, we'll have a misdirection. So we have taken the median, and you notice here that the median scores of the R-squares on stationary data is much better as compared to that on the raw data. So this is definitely telling us that making the data stationary has a huge impact on the predictive accuracy of the models. Next, look at the standard deviations. That is the variance that we notice in the R-square scores is much lower when we are utilizing stationary data as compared to when we are using raw data. This is another evidence that making the data stationary helps the model to generalize much better. Next, in terms of accuracy of prediction, we notice that the accuracies are better when the stationary data is utilized, and the accuracy is the best when we utilize GRU model on the stationary data. From a computational point of view, when we compare the amount of time it has taken for the models to converge, you notice that the models take longer to converge when trained on raw data as compared to when trained on stationary data. And the GRU model on stationary data converged the fastest. We've already seen the charts regarding the predictions made. We can definitely say that the prediction made with the GRU model is very good. And not only it is good, from the R-square score, we can conclude that these models have generalized pretty well. So we can rely on these predictions from this GRU model trained on stationary data. Now coming back to the research questions, we notice that making the data stationary has an impact on the predictive power of the stock market models. Now we notice that making the data stationary makes the models predict much more accurately, and also they generalize much more better. Second, the GRU models have consistently outperformed ANN, RNN, and LSTM in this experiment, and the GRU models obtained higher R-square score, and the variance of R-square score was much lesser, and the GRU models required fewer training cycles. So this means that the GRU models were predicting more accurately, and it was using less amount of computing power, and it was more robust. Last, most importantly, we noticed that even though we have made progress in terms of making conclusions like making data stationary improves the predictive power, we definitely can say that there are limitations of using machine learning for predicting the stock market as of today. Especially, we have noticed consistently that the machine learning models could not predict well when there was an external shock in the environment. In conclusion, we can definitely say that this research has taken the field of step forward where we have seen that making the data stationary definitely improves the model's generalizability, predictive power, and robustness. So, any future research can start with the starting point that they should use stationarized stock market data instead of raw stock market data. Second, we have seen that GRUs have outperformed ANN, RNN, and LSTM. However, different models, different network architectures will come in the future. But as of today, if we use singleton architectures, then GRUs are performing much better. One of the key improvements what this research has done is that just consider the sliding window approach, where using this technique we could test the models on different market conditions. So it was on the different market situations, economic situations, political situations, where the models were created and tested. So this gave a very diverse view of what machine learning models could do under different circumstances. And we have seen that despite using advanced model architectures and data transformations, etc., there is several limitations when it comes to predicting the stock market during the situations of sudden market movements or external shocks. Lastly, this research has definitely given a scalable and transparent modeling framework. All the code and the different data sources and the data has been provided along with the research document. So it can be replicated very easily by anyone who is trying to create this model once again and test it. And that means to say that these models can be created by anybody, whether he's a small investor or a big investor. And these models do not require too much of resources to create. As a result, it is definitely democratizing the stock market prediction market. Though this research has taken the field forward, there's a lot of work required before a completely reliable model can be prepared for stock market prediction. Now, this research basically relied on singleton network models. However, in the future, we could try hybrid models like we could combine GRUs with CNNs. CNNs could capture the different patterns in the stock market data, and GRU could then model the sequences. This is one direction. Second, we could utilize the latest technology of attention mechanisms to notice if we can capture the most important parts of the sequences and model around them. Third, we could try a transformer based model. Transformers are the latest. Transformers are proved to be very useful in natural language processing, etc. However, they have to be proved in financial data. Now, one of the problems with applying transformers is that a huge amount of data is required to train transformers. Now, getting that huge amount of data can be a challenge. But however, if that challenge is overcome, then it could be worth seeing whether making transformer based models can make better stock market predictions. Fourthly, this research basically relied on quantitative data. However, some qualitative factors also need to be factored in. Things like psychological impressions of investors or the different aspects, the sentiments in the market, etc. If this could be captured effectively alongside the stock market indexes or the stock prices, then such quantitative sources of data can prove to be very useful in making reliable stock market prediction models. Lastly, the scope of the macroeconomic indicators could be expanded. to also you include geopolitical indicators. Now, these data, it requires to be seen how such things can be modeled, because first of all, capturing such geopolitical data can be a challenge. And second thing is that even if they are captured, then how can they be represented? Just like we could represent the macroeconomic data, has to be checked. So once these data can be modeled properly, then we can build models on top of that for making more reliable stock market predictions. So there is a huge amount of work ahead which can be done to improve this field. Nevertheless, I hope you found that the progress made by this particular research is significant in terms of making your investment decisions or making models to make your investment decisions more reliable in the future. Thank you for your time. Namaskar.